Let's welcome in a very special guest at this moment. Andrew Holland is now joining us. Andrew, good morning. Thank you so much for taking out time for us. Can you just talk to us about results, what's happening in terms of liquidity, actually what's happening in the market? Are markets getting complacent?
I think globally markets are very complacent. I mean, the VIX in the US has been under 10. It's just hovering above 10 at the moment, and so it's telling you really that there's no risk that people can see. And listen, I can work with that too. A lot of the risks that we came into the year, Trump coming in as president, and what problems could that cause, seem to have ebbed away. Obviously, the French elections went in favour of Macron, and some of the the more kind of geopolitical, Syria, North Korea, whilst North Korea's still kind of on the radar, have kind of quieted down too. So, we're in that kind of Goldilocks scenario at the moment, aren't we? Where bond yields are stubbornly, staying low, and the liquidity is just finding its way into the markets. So we have to, it's hard to fight the momentum. You just have to go with it till something changes. But at the moment, it's difficult to say exactly what that would be. My guess it's probably something from China, because we are seeing a slowdown there, and we saw it in last week's figures in terms of imports and exports, which were half of what the markets were expecting, and today in terms of factory data, again, which is showing to slow down. It happened in April. So if China does slow, we could see another kind of risk-off trade coming, but the evidence is not fully there yet for markets to get worried. So we're in that usual scenario with liquidity where bad news is good news and good news is great news.
Right. Do you think that biggest risk in the market is what happens to China?
Yeah, I mean, if it continues to slow, and obviously they're doing a lot of tightening at the moment, that has a number of impacts. One, it will obviously hurt the banking sector, and particularly the shadow banking, and that's where we're all concerned about with China. And two, they'll have to try and export the way out of it, which means, could they depreciate their currency again? And that's one of the things that we have to bear in mind. So, I think China would be, to my mind at the moment, the biggest risk that we're facing in terms of a slowdown in demand. And maybe you're seeing that also in terms of what's been happening recently in commodity prices, because China's not a buyer at the moment. So, at the moment, the market, though, is just ignoring these kind of factors. They did it a long time ago, if you remember, up until they depreciated in 2015, the market was very complacent that China would be okay. I'm not working on that view. I think there's something slowing there very quickly again, and the actions we'll see over the next few months of what they can do to arrest that.
Right. And with the valuations that are there, not only in India but globally, any surprise on the negative side, and markets could go down significantly, or at least there could be a rush to sell for a few months or weeks?
Well, certainly, a lot of the results coming out from the US markets have been particularly strong, particularly on the IT side. I'm talking about the Apples and the Twitters and so forth, not IT that we think in India. But then I saw retail sales in the US and the retail results, retailers' results, which are very poor. So again, there's a bit of a mixed signal coming from the US. I think, if I was to think about globally, I think it's, Europe is looking cheap. I think Japan, if they can continue the progress they've made, is still looking cheap. And India, remains relatively high in terms of valuations. But I'm not really particularly worried about that, because earnings will pick up. But I don't think earnings are going to pick up this year, because I still think if GST is implemented on July the 1st, then that will disrupt the economy and companies for at least one quarter, if not 2 quarters. So it's 2018, which is the year of strong recovery in earnings, to my mind. But we'll see if GST is implemented and what the dates are.
Right. But don't you think that, a lot of people know that GST can be a disruptor in the near term, and that's why people will wait for the implementation and what is the outlook for next year rather than just discounting what will happen this year?
You see, markets can't, valuations can't continue just to kind of move higher. You have to see some earnings coming through as well. And if that's, not till 2018, then, yes, you can have a little bit more PE kind of stretch, but it's hard to kind of push that a lot further forward when you really don't have the evidence that earnings are picking up. So it's been another, it's going to be another year where we started off with expectations of 20% earnings growth, and they're already down to 15 and probably heading towards 10. So I think, listen, liquidity makes us all feel as though, the economy and earnings are picking up. But, the commentary from a lot of companies is still, very kind of downbeat. And I expect that will continue all the way through as GST is implemented. Remember, it's a big, big change. And it also includes, tax. I think we're underestimating the disruption that could be. Already, I'm speaking to companies who are saying that destocking is already starting in some sectors. So, you've got to be aware that, companies are not so confident of the outlook in the near term with GST. I mean, longer term, GST is a great game changer for lots of industries. And that's the good news, and that's probably what the market likes. But you can't have valuations going too far ahead of where we are today. It's just really liquidity is pushing them there at the moment.
Right. Just what is your call on the macros or the macro data that is coming in? So we got the CPI data that came out over the weekend. We got the revised IP series, which is looking positive. Growth data has been positive. At least macros are in the favor of markets to go up, or earnings at least to pick up. May not be this year, but sometime soon.
Yeah, as I said, I think earnings will pick up, but it'll be it's the 2018 story, which is why I'm not overly negative about markets at this stage, even though valuations are stretched, because I do see that pickup coming. But what I'm trying to say is that the catalyst for markets to move a lot higher is really based on only liquidity rather than the fundamentals. So at some point, not just for India but globally, we'll come back to fundamentals. And whilst it's our base case is for global growth to really pick up now, it's not going to be it's not going to happen overnight. So I think it's still going to have a little bit of volatility there. So this complacency that we're seeing in terms of risk is worrisome. And if you look at the occasions when VIX has, and I think it's been 10 or 11 times when the VIX has been under 10. In the history of the US, then 1 year later the market's always negative. So something will come to change our expectations on risk. Whether that's this month or next month, I don't know.
Right. What do you make of the disclosure from Yes Bank that has come in? Do you think it's something which investors should worry about, or it's a backdated data and everything has been provided for? So look at forward things going ahead. Yeah,
no, listen, I think they did say there was a divergence, and maybe the market was surprised at the size of the divergence, and that's all there is really to it. So, it's I'm sure the management of the bank will clarify what they need, or have clarified what they needed to, and maybe going forward, we'll be looking, or analysts will be looking more about, giving actual divergence numbers. Rather than just taking into account what banks say in terms of that there's no significant divergence that they have since they reported those numbers. So I think maybe it's a little bit more of corporate governance in terms of disclosures, rather than it's a big shock to the banking system. Because anyway, I'm not believing half of the things that the banking sector is saying in terms of their problems, and each quarter you see a new problem coming. So until they really disclose where they all are, then you're always going to run this risk of something just kind of popping up and saying, oh, I didn't know about that, and that's some disclosure which I have to make, or more provisions that you weren't talking about before. So this is going to be a continuous process for at least for the next 2 quarters.
But for a company like Yes Bank or IndusInd Bank, do you think growth outlook still continues to be positive? So they'll continue to grow at 20-25% CAGR. That is something which the markets is already factoring in?
Yeah, listen, I think all the private banks will continue to grow strongly as the economy, kind of continues to move ahead. But more significantly, they'll continue to take market share from the PSU banks because, they have such, a terrible time at the moment in terms of just managing their own balance sheets. And in some cases, the RBI is even stepping in to restrict what they can do. So this is just a great opportunity for private banks to continue to take market share, particularly as the economy is, robust the way it is. But if you don't have the balance sheet, you can't go out and do anything, and that's where the PSU banks are. So the private banks will continue to grow very strongly, and 20 to 25%. It seems a reasonable figure to be forecasting at this point. So no concerns on that front.
Right. Do you think private banks or private NBFCs are still one of the best places to play this macroeconomic growth?
So I think NBFCs, again, because of the problems in PSU banks, have been able to take market share and gain in terms of the momentum. I think if I look at the overall sector of affordable housing, I think housing finance companies is where I'd probably concentrate a little bit more. And I know that prices have moved up and valuations are very stretched. But that said, if I fast forward 3 or 4 years, then it will be a huge sector. And it's really just trying to pick out 1 or 2 of those winners from that. Where valuations might look very high now, but if you were 3 years on, they would have looked cheap at that point. So that's the kind of evaluation we're having. So NBFCs will continue to do well, but we're thinking more around that affordable housing and that theme over the next 4 to 5 years.
Right. Just a word as far as, private banks or NBFCs are concerned. Do you think markets have realized that the risk over there is lower because of the management, because of the way these companies have been performing, and that's why they are trading at such a significant multiple versus some of the others in the sector?
Well, listen, I mean, it's markets giving valuations, and let's just take the PSU banks, right? Price to adjusted book is around, 1.3, 1.4, not dissimilar to, say, ICICI Bank. So, I think the valuations of PSU banks are too high, given that they're just losing market share to the private banks. So the private banks, to my mind, if I look at the valuations, again, stretch. But if I fast forward 2 or 3 years and think about where the economy will be, and where the banks are positioned with the stronger balance sheets to take advantage of that, then I can live with these kind of valuations, because they will, they're growing at 20 to 25% in what I would say is really a robust economy, but not a kind of expanding economy. So, if you see that expansion over the next 1 to 2 years in the economy, which we'll be expecting after GST is implemented, it's going to be the private banks who have got the wherewithal to get out there and garner the business, whereas the PSU banks, unless they really kind of write off all of their problems, which is what's being talked about, then they really don't have that ability or capacity to go out there and do anything about a growing economy. Yeah, they can do things on the margin, but they're so saddled with their own problems that it's just going to take a whole long time for them to be able to compete with some of the more kind of swiftly and actively managed private banks.
All right. So for the lending space, you remain pretty positive. You said that there is some destocking taking place in the run-up to the GST. Now, would you then look at consumer stocks a little differently now, or do you think there are some that would continue to register strong growth going ahead? If you take a look at the FMCG earnings so far, it's a mixed bag. It's not uniform across the board. So how do you play the consumer names from here on?
So FMCG, after many years of not being able to kind of swallow the kind of valuation levels which were there, given that their growth was sub 10% in terms of top line growth, we think GST is that game changer for them, and our kind of thinking is that let's move away from the kind of IT and pharma as being those safety sectors, but with strong growth, towards the FMCG companies, where we now see, going forward that sales or sales growth can actually kind of get into that mid to high teens, which will obviously have a very big impact on the bottom line going forward. So for the first time in a long time, we've become more bullish on FMCG. One particular company which was received a hostile bid at its parent company, which has managed to kind of stave off for the time being, really will have to get their act together, not just in India but globally, and that bodes well for that company as well. So overall, we think we're shifting away from pharma and IT and telecom as you're going to safe domestic growth stories in India to more FMCG, where we see, despite the valuations, huge amount of re-rating for the sector as earnings and start to really kind of accelerate over the next 2 to 3 years.
Right. What about the other consumer durable names? Some of them have done very well, like Havells and Voltas. The penetration level for some consumer products in the country remains low. And there is a belief that the shift to the organized spaces is going to benefit some of these names. Would you look at investing in any of these afresh?
Yeah, so it all kind of falls under, there's a couple of themes playing this kind of overall sector. Apart from GST is obviously a game changer for them in terms of a level playing field coming about, but also that whole affordable housing, and we're expecting the kind of real estate market to kind of start to stabilize, if not see more transactions going forward at the mid to top end as well. Bodes well for any of these building material or suppliers, whether it's air conditionings or whatever, to homes going forward. So we think it's a great theme in terms of surrounding both GST and affordable housing. So that's the kind of those stocks are the ones which we are owning, because we feel that the long-term future in terms of both the re-rating of the sector and earnings growth is going to be significant.
All right. Now, you mentioned commodity prices seeing some pressure because of what's happening in China. Perhaps a slowdown is headed there. Then what does one do with the commodity companies, ferrous and non-ferrous in India? Because some of them have done very well, from the low base of last year. Their earnings are looking very good. They have rewarded shareholders who have held on to them for the last year. From here on, is it time to be cautious, or you think this is just part of a cycle, and from here on, they will be able to recover again?
So I'd be a little less positive, say, on the steel companies in the short term. One, because if China does slow, then that's a price. The price could erode a little bit more from where we are. Plus, also because of the rupee appreciation against the yuan, China's steel is looking a little bit more attractive to import. Despite the differentials. So, I don't see the potential for, domestic steel companies to keep increasing prices. Otherwise, they're going to get a flood of China imports, that's for sure, coming into the market. So I'm not overly negative on the commodities. I'm just saying that China could have has had an impact, and you've seen that in the last 2 months. I think now the prices are towards, I would say, fundamentals in terms of both supply and demand are looking more fair. But if the slowdown accelerates in China, then obviously there's another leg down for the commodity pack across all the kind of sectors. So I would be less inclined to be a buyer of steel companies at the moment. I think there's a little bit more headwinds for them in the very short term.
What about the non-ferrous space? Do you think they could tend to fare better? The likes of Hindalco, Vedanta. What about some of the crude-related plays in the exploration space? Do you think they could fare better?
So there's again, I think if I look at the non-ferrous, and one of the themes that we talked about with you before is global growth taking off. And if that does, then, you know, for the likes of, say, Hindalco, should do very well, because I think that will keep prices, you know, kind of bubbling at the higher levels, rather than you know, there's just a China kind of slowdown. So I'd be more favourable towards that sector than the other sectors. In terms of the oil price, you know, we think that the oil price could move to 60 towards the back end of the year. But, you know, there's a lot of kind of concern over, you know, shale, and obviously whether OPEC can keep their quotas. So that's why we're seeing the oil price just not being able to move. Fortunately, it's not falling either. So, you know, I don't think I want to be in the kind of oil sector per se. I'd rather kind of look at, you know, say a Reliance, where, you know, the GRMs are reasonably strong, but obviously they have other parts of their business now, which is you know, is showing some value for the first time. And of course, they're coming towards the end of their capex cycle, so they're going to throw out a lot of cash, and hopefully with that cash they'll also pay higher dividends. So, you know, I think I'd rather kind of keep there than I'd look at the kind of either the kind of exploration or, you know, kind of pure oil marketing companies at the moment. I think valuations are pretty high, you know, for what I see as being not great kind of a great industry in terms of, you know, I can see a lot of re-rating, or the re-rating's already taken place, and therefore earnings are not really going to jump up significantly over the next 1 to 2 years. So it's a sector which will you know, which will do okay, but it's not one which excites me.
All right. Andrew, you said you like FMCG as a good defensive bet, even if they have high valuations on strong sales growth ahead. You rather buy FMCG stocks than buy IT, pharma, telecom. Then what is the prospect? What are the prospects like for these sectors, IT, pharma, telecom? What kind of growth can we see there? Are they risky yet? Would you avoid them altogether? Do you think on low valuations, some of them present a good investment opportunity?
See, on the IT sector, and we've said this for a long time now, is that, you know, we do believe that the sector is ex-growth, and you're seeing this. I mean, you're seeing, you know, where the revenue figures are, you know, if anything, you know, single digit, you know, mid-single digit. I mean, and, you know, one of the companies said that, you know, they might actually have a negative growth. So the sector itself has gone ex-growth, and, you know, it's whether they can reinvent themselves now. And if they can't, then there's only two ways out. Is one, pay shareholders more dividends. You know, that's the way I kind of think about it at the moment, is what's my dividend yield. They do have a lot of cash. They're throwing away a lot of cash. And maybe the restructuring they're doing will help their margins going forward. But I'm not wanting to pay 15 to 17 times for, you know, a sector which is kind of ex-growth. So you've got to give me something more, and I think that's got to be dividend yield for me to be in, to find that, you know, valuations are more attractive. So still avoiding IT. I think the same story goes for pharma. I think, you know, it's gone ex-growth, and, you know, again, I think the particularly generics have to reinvent how they, you know, how they're going to do business going forward. And surprisingly, and I say surprisingly, you know, after 2 years of regulatory visits and problems in the plants, they're still having problems. So I don't know what the fundamental reason is behind that. But obviously that's a big hurdle for them to get over. And in telecom, you know, the recent results from Bharti and Idea is really like everyone's saying, oh, it's a relief that, you know, it's not as bad as it could be. You know, it's going to get more intensive in terms of the competition. You know, we got a merger of two companies coming. You'd still have Jio out there, you know, which will continue to want to increase their market share. So, you know, I think we're another 2 to 3 quarters away from the pain being away from this sector. So it's not something I need to kind of be in at the moment. I'm looking at it because valuations are starting to look a little bit more attractive. But, you know, I think there's a time, and the time is not now, because I think the competition is going to not just intensify. I think it's going to become a little bit more stronger going forward as two entities merge and everyone tries to emerge out of it with more market share. So, that's the feeling I get at the moment is I don't need to be in the telecom sector. There is, you could say, value coming, but I'd rather miss the first 5 to 10% of a share price rise and get the timing right rather than think about dipping my toes now.
All right, Andrew, thank you so much for speaking with us at NDTV Profit and sharing with us your views on what's happening globally and the stocks and the sectors that you like.